Welcome back, investors, to Ticker Time News. I'm Adam. What a turnaround in the markets today. We started off red and deep in the red this morning and turned it around to end up with a green market for the end of the day to end out the week. So it looks pretty good, right? I hope you did well in the markets today as well. Now, here we are back for another after market live stream, a market close live stream, the after hours show, however you would like to define it. Now, the most important thing about this show, it doesn't matter what stocks I have lined up to do deep dives on. The most important thing is what's on your mind. So if you have a question, leave that ticker symbol and your question in the comments, and we will go over it live during the show. Now, before I get into my opening monologue, I want to remind everyone that Webull has a special right now. If you have not signed up for Webull yet, you can right now and get 5 free stocks. That's right. It's free money, folks. Sign up for Webull by clicking the link in the description, tickertimenews.com/Webull. I'll actually post it in the live chat right now. There's the link in the live chat, tickertimenews.com/Webull. And all you have to do is sign up for an account, deposit any amount. That's right. $5, $10, it doesn't matter. Any amount and get 5 free stocks. This is valued up to $8,300. Of course, not everyone will get that amount, but it's what it's worth for, I guess, the lucky person to sign up, right? So make sure you are one of those to sign up for a free Webull account, deposit any amount, $5, $10, it doesn't matter, and get 5 free stocks. It's free money for the holidays. I know everybody could use it, so take advantage of it. tickertimenews.com/Webull. The link is in the live chat and the link is in the description below. So take charge and get that free money. All right, I won't talk about that anymore during the live stream. Let's just hop right into it. While you get your questions ready to go, I'll do my opening monologue. We'll dive into your questions, or if not, we can go through the deep dives. I've got RIVN that I want to go deep on today, as well as Fedex I want to go deep on today, and Darden, which is the primary owner of like Olive Garden and Longhorn Steakhouse. They reported too. So I wanted to talk about those 3 in particular. And a couple more. There was a couple of earnings and upgrades and initiations today. So a lot to talk about. So let's just get right into it. But remember, the most important thing, really, seriously, your questions. If you have a ticker symbol, leave it in the comments. Leave your question. We'll go over it live during the show. We had a very active chat yesterday, and I always find that to be the most important and the funnest part about this show is answering your questions. So make sure to do that. All right, stocks were volatile today. We know that. It opened red and then it turned green throughout the day. Probably the first couple of hours of the day, we had that pain in the market, and then it turned to excitement with volume actually 30% higher than last month as investors assess a more hawkish shift in monetary policy, not just from our own Fed, but from all central banks around the world. The global monetary policy is taking a very hawkish stance right now. And there is the spread of the Omicron virus that is getting in the headlines right now. New York actually reported their worst case numbers today than at any point in the pandemic. Not last year, not earlier this year. Today was the worst, the most counts for the virus in a single day was today. So New York City is under siege right now. We'll see what that brings. That could bring a little pain to the market if that spreads outside of New York City and continues. So we'll just have to watch that. It's a fear that could take over the market. So just be cautious of that and any news around it. Now, the Dow Jones shed as much as 500 points. That's right, 500 before turning around. The S&P closed 1% lower as the bank shares, including Goldman Sachs, American Express, JP Morgan, and Visa, which were the biggest gainers on today, right? While they were down sharply. Let me get my thoughts right. They were the biggest gains yesterday, but today they were down sharply. All right. Meanwhile, the tech-heavy sector, the Nasdaq, it closed around the flat line today, made up a lot of losses from earlier in the morning, just like crypto did, which we'll look at Bitcoin in just a moment, after losing almost 1.4%. So it gained that back throughout the rest of the day. Still, all three main averages booked losses on the week. Now, the COVID-19 situation seemed to weigh on the market, with sporting events continuing to get postponed. We have the NFL postponing several games this weekend due to outbreaks. We had President Biden warning of, quote, winter of severe illness and death for the unvaccinated. Of course, he says unvaccinated there. Why not just everyone, huh? Okay. And we have the former FDA commissioner also suggesting that businesses in New York might close voluntarily, close on their own without government intervention for a few weeks during or due to the surging cases. Like I said, we need to keep our eye on New York City and what's happening there, because it could spread out from there. All right. All this FUD or doom and gloom, however you want to look at it, would be enough to wreak havoc on a market any day of the week. So it is kind of surprising that we turned it around today. Now, all 11 S&P 500 sectors closed lower, led by the cyclical financials down 2.3%, energy down 2.3%, and industrials down 1.7%. They were the worst performing sectors. The Treasury yield curve flattened amid increased demand for longer dated maturities, and oil prices settled down sharply lower. At least I think it was 2% the last time I checked. The real estate sector, it was down 0.3%, and that was the best performing sector, down 0.3%. Technical indicators and factors were most evident in the S&P 500. On my chart right here in front of you on the screen, this is the S&P 500. You can see the last candle for today, it is sitting, or it did bounce right off of its 50-day moving average. That is important, as we say nearly every day on the channel. If we're above the 50-day moving average, that's positive or bullish. When we're below that 50-day moving average, that's negative or bearish. But it did find support there at the 50-day moving average, which is good. It did dip below it just a little bit this morning, but did bounce back. Now, the mega cap stocks, right? They lifted the benchmark index off from its lows earlier in the morning, as investors presumably saw their recent declines as a great buying opportunity. So we saw a buy the dip mentality this afternoon. However, small cap stocks and retail stocks saw some relief after lagging in recent weeks, benefiting from a rotation-minded activity. The Russell 2000 and the SPDR, the Spider S&P retail ETF, that was up 0.5%, but both entered the session today. Man, I am just getting, I don't know why I'm extra nervous today. Is it because it's a Friday? It's the last show of the week. I don't know what it is, but I've got the nerves today for this live stream, let me tell you. All right, moving on that. So they were in correction territory, down more than 10% from their recent highs. Now, Oracle, ticker symbol ORCL, man, it's been clobbered. It saw no relief after the Wall Street Journal reported that the company is in discussions to acquire Cerner, ticker symbol CERN, for as much as $30 billion. So Oracle shares fell another 6%, and Cerner shares, they rose 13%. RIVN, which we're going to do a deep dive on in just a moment, dropped 10% after missing EPS estimates, while Fedex, which we're also going to do a deep dive on in just a moment, rose 5% on pleasing earnings news. FedEx also authorized a new $5 billion share repurchase program. And remember, that's just another way that a company can reward investors, right? Okay, as a reminder of where we stand as we close out this week, the S&P 500 is up 23% year to date. The NASDAQ is up 17.7% year to date. The Dow Jones is up 15.6% year to date. The Russell 2000 is up 10.1% year to date. And then Bitcoin, it's up 61.8% year to date. But Ethereum is the big winner. Ethereum is up 431.6% year to date. So all of you Ethereum holders, great job with that. Lots of gains there for you to lock in if you want to for the year, or just keep carrying it over to next year for more continued gains. All right, let's look at Bitcoin, BTC USD on TradingView. Now, there is a link in the description for a free account to TradingView. Here's Bitcoin. We've been curious about this 200-day moving average for Bitcoin. We really wanted Bitcoin to stay above it, but I hate to say it, it is now below the 200-day moving average. Yes, it is. Now, today, Bitcoin is down 2.69%. It was down a little bit more than that. It dropped down to a support level today at a low of 45,496. So we have a support level at about 45,500. So it dropped $5 below that support level, and then bounced off of that to sit where it is now at 46,283. Okay, that 200-day moving average for Bitcoin is at $47,019. That's where it is right now. That's where Bitcoin needs to get back above. It's only a couple hundred, $275 or so below the 200-day moving average. So we really need to get Bitcoin back above that. Underneath this 200-day moving average, if we go back and look, now this is the daily chart. If we go back to here, September, Bitcoin dipped below its 200-day moving average. And October the 1st is when we started the rally, and Bitcoin popped right back up above that 200-day moving average. Now, just to remind everybody, this rally here, it started right here, and then Bitcoin's first rally before the double top ended up here, 63.3%. That's the rally from under its 200-day moving average, 63.3%. Now, if we go back and look even further, Bitcoin was under its 200-day moving average starting back here on May the 18th of this year. And then it fell, it kind of reached its bottom point here, it rallied, it broke above it, but only stayed above that 200-day moving average for about 3 weeks or so, and then dipped back down below it. So, are we going to see this same kind of pattern where Bitcoin is going to fall below and stay below the 200-day moving average and be down there for months until next year at some point before rallying again? Or is it just flirting around with that 200-day moving average right now and it's going to somehow get a boost of momentum. Now, the crypto market, it used to be uncorrelated to the stock market, right? Bitcoin moved in its own way. It would be up or down, have no correlation or relation to the stock market. Now, though, Bitcoin, it's a technology, right? Is that fair to say that Bitcoin is a technology? It seems that with more institutional investors getting involved with Bitcoin and cryptocurrency, that it is becoming more correlated, or at least related, to how tech stocks move. When tech stocks go down, so does Bitcoin. When tech stocks go up, so does Bitcoin. Now, maybe it's just too early to say that there is a relation between the two, but I have noticed that pattern. However, Bitcoin can have much bigger moves than the tech sector when we're talking about equities. Now, looking at Bitcoin here, it hasn't completely fallen off the rails and outside of its long-term structural trend lines, right? If I tighten this chart up here so we can get a bigger view of Bitcoin, you can see there has been some wild rides recently. But if we look at these trend lines on this big open view of the past year and a half, man, it would have been great to buy Bitcoin last October, right? It was down like $12,000 a year ago, and now it's up to 46,300. So that is a nice gain when you look at the grand scheme of how it's been performing. It's up, what, 61% year to date, like I said earlier. So it's okay that we have a pullback every once in a while. It's expected, especially for big runners like Bitcoin. So if you are invested in Bitcoin, don't get discouraged with this pullback. It's okay. And it is still in these trading channels that it has been trading in now for nearly 2 years. So everything is still looking okay. For me, though, this bottom trend line here, all right, if it broke below that, and if you go back here and look right here on the 21st of July, it got right down to that trend line and bounced off of it, the bottom trend line here. Is Bitcoin headed for the same fate as it did earlier this year? I don't know. I don't know where Bitcoin's going. I do know that where it is sitting right now, 46.2, it does have a bit of support here. And of course, that support line down here at 45,500, maybe that's just where it's going to bounce around. 45 to 47, 48 or so, and maybe it's just going to bounce around there and consolidate. I really have no idea, but it's something that you can watch. And I am long-term bullish on Bitcoin. I own Bitcoin, and these lows that we're seeing right now, for me, they're just an opportunity to continue expanding and growing my position. I am totally on board and bullish for Bitcoin in the future. So it's a buy and hold. That's my mentality for Bitcoin. And these daily movements that we see, it's just part of people trading Bitcoin, right? All right, let's look at Ethereum since it's the big winner for performance this year, up over 400%. Now, when you look at Bitcoin, it's down here, like on the next to the bottom trading channel, but Ethereum is not that low. And for this same trading channels, multiple trading channels here, or multiple trend lines, if you want to say it that way, Ethereum on July 21st also got to the bottom rung, the bottom of the trend line. okay? Just like Bitcoin. But Ethereum has not fallen as much as Bitcoin has. As a matter of fact, Ethereum is I would say, beginning to become more stable than Bitcoin, right? Look at it here. It's using this trend line right here as support. It dips a little bit below it, but it has always been bouncing back above this trend line. So I find it interesting. But with Ethereum, there is a big psychological number, 4,000. That's an area where Ethereum, when it's above 4,000, it feels a lot stronger than where it's at right now at 38.74. But that's not too far below. It's that $4,000 level, right? And it did get down as low as 36.99 today. So it broke down into the 36s, and now it's up to the 38. All right, let's get off of crypto here, and let's move on to some of the deep dives. But right quick, I want to go rapid fire through just a few companies that had a little bit of news today. First is Expensify. It's a new company that went public recently. Ticker symbol is EXFY, Expensify. And again, they just went public recently, but they had their very first earnings report. And their earnings were pretty good. Their revenues jumped 72% year over year. And they say that small and medium-sized businesses continue to bounce back from the pandemic, which is good. They also guided their Q4 revenues above estimates. So looking good. And it was one of the companies on the Catalyst Watch that we posted on our website, tickertimenews.com, on Sunday. Now, another one that we talk about quite frequently is Deere, John Deere, Deere and Company, right? Ticker symbol DE. Well, John Deere, it's a company that's been around for a very long time, very, very long time. Agricultural company. They build tractors and farm equipment and so forth, and also mowing equipment and just all kinds of equipment. Manufacturer, right? Well, a lot of analysts cover Deere and Company. Well, another one joined the pack today. So there was Deere initiated with a buy from D.A. Davidson, and they gave Deere a price target of $400. So that's a pretty nice upside for Deere from where it's at right now, about $54 or so from where it's at right now today. All right, the next one real quick is Roblox. RBLX is the ticker symbol for Roblox. They also had an analyst started to cover them from Needham. They gave them a buy rating and a price target of $136. They're at $102 right now, so $136. That's a nice move to the upside. Just about $35 from where it sits today. Now, it was good to see Roblox up 7.5% today, because they took a large tumble right here. You see this gap down here right after the Fed came out with their news. And so they recovered some of that. They're back above their 50-day moving average now. Maybe they can march up and meet that resistance here that they've been bumping heads up with here recently. Okay, let's get into the deep dives. First up is RIVN, RIVN. All right, RIVN. That's who we're going to go to first. Okay, haven't been public very long. We know that. Earnings came out yesterday. In yesterday's live stream, we talked about RIVN, and on the chart, they were down 11%, 12% in after hours after their earnings came out. And we talked about, I didn't know how low they would go, but I felt buying under $100 was a good opportunity. Buying in the 90s was a good opportunity. Who knows? Maybe it could have dropped to the 80s. It didn't. It got as low as 92.62, and it's at 97.87 right now. So for Rivian Automotive, ticker symbol RIVN. It's an upstart electric vehicle or EV maker, Rivian Automotive. They're encountering some speed bumps after the company's blockbuster IPO in November that generated a windfall for the company and its investors, like Ford and Amazon. They were investors. They got a windfall in cash as well. In the wake of last night's Q3 earnings results, Rivian's first earnings report as a publicly traded company, shares are in reverse today and are now trading more than 40% below the stock's post-IPO highs. For the most part, Rivian's current top and bottom line performance is frankly irrelevant since it's in the early stages of production. In fact, the company only generated $1 million in sales in Q3, while producing just 612 R1T trucks as of December 15th, 2021. During this initial ramp-up phase, losses are completely expected and thus are insignificant to most investors. Rivian making a loss of $7.68 a share, that loss is irrelevant too. What is critical, though, is that Rivian's future growth plans remain on track. While the outlook is generally bullish for this topic, a familiar issue surfaced last night that's creating some concern. Namely, supply chain disruptions are rearing their ugly heads again, putting a wrench into Rivian's 2021 production outlook. After initially forecasting production of 1,200 vehicles for this year, Rivian now expects to fall short of that target by a few hundred vehicles. That may not seem like a significant concern, but the downward revision serves as a warning that those ongoing chip and component shortages are only going to make Rivian's production ramp-up plans very difficult to achieve. As it currently stands, the company intends to increase production at its Illinois plant by 50,000 vehicles before ultimately reaching its goal of 200,000 vehicles at the facility. In addition to its earnings, Rivian also announced that its new facility will be located in Georgia, and it will have an estimated annual capacity, not deliveries, but a capacity of 400,000 EVs. When the Georgia plant comes online in 2024, the company will have substantial capacity, which should allow it to effectively and efficiently compete against EV leader Tesla when it comes to pickup trucks and SUVs, and upcoming EV players like Ford Motors and General Motors. With 71,000 net pre-orders for the R1, demand is certainly not a concern for Rivian. Considering that deliveries of these vehicles likely won't happen until sometime in 2023 or beyond, the robust interest is pretty impressive. Amid these supply chain disruptions, Rivian will attempt to fulfill this strong order book while also churning out Rivian commercial vehicles or RCVs for Amazon. The e-commerce giant, which holds a 20% ownership stake in Rivian, ordered 100,000 RCVs to modernize its delivery network. To say that Rivian will have its hands full will be an understatement. Rivian has a long road ahead of it, but the automaker is on the right track. The main takeaway from Rivian's first earnings report is that the tough production challenges that it faces came to the forefront. Whether you love him or hate him, Elon Musk's frequent reminders that launching a new vehicle or a prototype is far easier than ramping up production of the vehicle. And that seems spot on today for Rivian. In addition to the supply chain worries, the ongoing rotation out of growth stocks isn't helping Rivian's cause. Looking beyond today's weakness, I believe that Rivian remains attractive from a long-term perspective, but the current market environment is clearly not in its favor. For me, Rivian's first earnings provided a great opportunity to buy shares under $100. I've been saying now for about a month that anything under $100 is your chance to own Rivian. So it's nice to see Rivian hold between the $92 and $99 range it showed today. What do you think about Rivian in their first earnings report? Do you think the supply chain issues will be any problem for Rivian, or will they be able to overcome that challenge? Let me know in the comments below. Okay, let's go on to Fedex now. Ticker symbol FDX. And let's talk about Fedex. It's a company that surprisingly a lot of people are actually interested in and following. I find that pretty cool. They were up 4.95% to close out today, and they're up 0.1% in after hours. Now, yesterday when we talked about their earnings, first we looked at the decline that they were in, going back all the way to the 1st of June. Big decline, big gap down from earnings last time around. But then it hit a bottom at the beginning of October, and it had a beautiful October rally like many companies did. And then it ran into trouble in November. But now it may have its footing back to take this rally that it was in. And if I put a trend line there, look at this. This trend line right here. If I line this up right there, I need to adjust this just a little bit. Okay. If we look at that trend line, right? Look at where, let me move this so it's not in the way. The circle that I drew during yesterday's live show, let's just remove this so we can see this a little bit better. One more little mark there. Okay, so yesterday its gap up, look at how high the candle wick went, almost to this trend line right here. So this is telling me that it's possible that FedEx could potentially be starting a new channel. This could very well be a new channel that FedEx is starting to move in. And if we mark the top of this one here, right there, can you see it now? See how it started this reversal back here at the beginning of October, had a nice October rally, pulled back in November, and then ran on this bottom trend line for its two lows here. And now it pushed up to the top of this trend line here in the middle. So it's possible that it's just going to extend and move within this channel. That's a possibility. And that's one that I'm watching here for FedEx to see if that does come to fruition here. I think there's a good chance that it could. Okay, let's put a vertical here for earnings, and then let's mark this one back here so we can see it a little clearer. All right, so there's FedEx on the chart. All right, let's talk about FedEx. So FedEx, ticker symbol FDX, is trucking higher today after shipping investors a solid Q2 earnings report, as labor headwinds improved significantly in the quarter. Recall that in Q1, margins took a massive hit as FedEx struggled to find enough workers, causing labor costs to soar out of control. As a result, the transportation company missed earnings by its widest margin in 5 years. FedEx didn't ease investors' concerns going forward during its Q1 call, forecasting ongoing labor constraints in the near term and only a gradual improvement in adjusted operating margins starting in 2022. Now that FedEx has crushed Q2's adjusted EPS estimates while also making major strides in improving its labor availability and, as a result, its operating margins, investors are warming back up to the stock. Adjusted EPS was flat year over year, but since analysts had been expecting a significant decline, the result was more than enough to be FedEx's largest beat since last year. Revenue also came in ahead of estimates, a nice change from the nearly in-line revenue FedEx posted in the previous quarter. Multiple factors went into the strong quarter. One was improving labor availability. FedEx hired over 60,000 frontline workers since its Q1 earnings call in late September, which helped immensely with unprecedented shipping levels in this quarter. The company expects to retain these workers even after the peak holiday season. FedEx also noted that it had over 111,000 applications just last week, more than double what it saw in early May. Another factor that was favorable was the pricing environment. The numerous logistics companies expressing difficulty securing enough workers to keep up with high demand levels, FedEx is in an excellent position to maintain a brisk pace for repricing contracts to ensure enough surcharge capture. This helped lead to robust adjusted operating income growth of 12.7%, sequentially to $1.68 billion, easily outpacing FedEx's prior guidance on flat sequential growth. As a result, adjusted operating margins came in at a decent 7.1%, a nice improvement from 6.8% in Q1. Since FedEx expected only a gradual improvement in margins starting in 2022, the 30-point basis move represents improving conditions, which the company needed to show in Q2 to turn the stock around. Although headwinds have eased some for FedEx, FedEx is still dealing with significant challenges that carry over from Q1. For example, although labor availability improved, Q2 profitability was dampened by about $770 million due to ongoing staffing challenges. Fedex expects labor headwinds to persist in Q3. In addition, as COVID-19 continues to linger, FedEx doesn't expect air cargo capability or its capacity to fully recover until 2024. Nevertheless, FedEx's move to increase its fiscal year 22 adjusted EPS guidance, even if only by the size of its Q2 earnings beat, shows that conditions did not worsen. In fact, conditions in certain parts of the world have greatly improved. For instance, import demand in Europe and APAC have made a full recovery to pre-pandemic levels. Also, demand out of Asia is continuing to be a solid contributor to FedEx's revenue growth. Bottom line, things are looking up, which bodes well for the United Parcel Service, or UPS, which reports Q4 earnings on February the 1st. So what do you think about FedEx's improving labor market? Do you think this will have a big enough impact on the company to turn it around and maybe pick up the slack where others cannot? It's a good question to ask. So let me know your thoughts in the comments below. All right, before we move on to our next one, Winnebago, give me a quick little second here. All right. Winnebago is WGO. Now, Winnebago, they build RVs or recreational vehicles. If you recall, we talked about Thor Industries not too long ago because they post their earnings probably a week and a half ago or so, and they completely blew earnings away. Thor Industries, that is. They also make recreational vehicles, just like Winnebago. So they're a peer or competitor, however you would like to call it. Now, I had some pretty good hopes for Winnebago, but I don't think they met them, at least all of them. So let's talk about Winnebago. Ticker symbol is WGO. So Winnebago is not finding a good place to camp today, even though the company topped earnings estimates by its widest margin in 5 years in Q1. With demand high and dealer inventories low, the pricing environment remained strong for the RV manufacturer, paving the way for exceptional margin expansion. It has also led to robust growth for the company's backlog, which jumped 116.6% year over year and 10% sequentially to $1.9 billion in the quarter. However, I think much of today's muted reaction is due to the potential for cloudy skies ahead for Winnebago. For instance, a growing backlog can also be attributed to certain supply chain headwinds as material costs continue to creep higher. Labor availability continues to be a constraint, and semiconductor shortages keep impacting productivity. In addition, the Recreational Vehicle Industry Association, the RVIA, forecast North American wholesale shipments. The expansion will be just 2% year over year in 2022, a significant slowdown from the 40% leap in 2021. Part of the slowdown is expected, or I should say, part of the slowdown in expected shipments could be due to the comeback of alternative accommodations. This is the most evident in the great quarters posted recently by various travel and leisure companies, such as Booking Holdings, ticker symbol BKNG, Expedia, EXPE, Airbnb, ABNB, Travel Plus Leisure Company, TNL, and of course Marriott Vacations, VAC, and the bullish color that they have provided regarding consumers' return to spending on travel. It could also be due to higher expected interest rates in coming quarters, as RV purchases are highly discretionary. Consumers are more likely to put off buying an expensive RV if monthly payments become unattractive. Rising inflation could also magnify this, making owning and operating an RV much more costly. Nevertheless, Winnebago has support from strong tailwinds, such as the rise in remote work, increasing outdoor activity, and an excellent past couple of years saw over 14 million households camp for the first time, which presents a strong argument for Winnebago's continued success going forward. This is, or I should say, this is highlighted by the solid start to fiscal year 22, as Winnebago more than doubled EPS year over year in Q1 to $3.51, crushing estimates in the process. Revenue also grew nicely, up in the quarter 45.7% year over year to $1.03 billion, despite lapping an unfavorable comparison of a 34.8% jump in growth in year over year a period ago. Even without accounting for Winnebago's recent acquisition of Barletta, organic revenues still jumped 38%. Towables led growth in the quarter, jumping 43% year over year, while motorhomes were close behind at 31%. Demand within motorhomes was concentrated mainly in Class B and Class A products, similar to what I saw with Winnebago's primary rival, Thor Industries, ticker symbol THO. Increased competition in Class B motorhomes over the past 5 years has led the market to become more saturated, and Winnebago's market share has been hurt as a result. In light of that, I like seeing continued demand for its Class B products, as it indicates strong brand awareness and loyalty. Lastly, gross margins improved 250 basis points year over year in Q1 to 19.8%. Winnebago's margins are nicely higher than Thor's October margins of 16.6%. The margin expansion is also a testament to Winnebago's ability to navigate the ongoing supply chain and inflationary hurdles it expects to continue through fiscal year 22. Bottom line, COVID-19 brought more people to outdoor lifestyles, which Winnebago has directly benefited. Although it is not showing up in the stock's price, Winnebago started off fiscal year 22 on a solid note, as the company looks to prolong its momentum from 2021 into 2022. What do you think about Winnebago? We had Thor Industries about a week and a half ago. They did really good. Winnebago, though, has greater margins. But look at this stock chart. Winnebago has been range bound for most of the second half of this year, with a low around $64 and a high of around $75. It just keeps pinballing around within that range. How can the stock continue to do that when the company itself is doing so much better? I don't know. Let me know your thoughts in the comments below. All right. We've got Darden Restaurants coming up. That's a restaurant holder. Olive Garden is one of their biggest holdings. Longhorn Steakhouse is another one. A competitor would be Cheesecake Factory. Now, the restaurant industry is one that is moved mainly by headline news, right? When there's news of COVID, the stock falls. When there's news of reopening, the stock goes up. And you can see the end of last year is that rally. As we thought we were getting out of this pandemic, the stock rose. Then we get to 2021, and the stock started to move sideways. And it really became a range bound. And I'm going to put a bottom and top. I'm going to call it 135 is the bottom. And to get to the top, we really got two. It's right about 150 for the top. That's a really tight range there. We could take it up, maybe to 155. That would capture three more of the peaks where it comes out of the top, like right here on the beginning of September. But then this real big one here, but that was off of earnings. And then, of course, it fell right back down after earnings. Let's get these lines on here, the vertical lines, to show when earnings were reported. That helps to let us see what happens in between earnings and what the moves are during earnings. So we can see that usually during earnings, it reacts in a positive way, especially the last earnings. This one, not so much. The last one, it had a gap up right out of this range. The one before that, a small gap up. And then the one before that, it also had a small gap up and then a pretty big run there of 8%. And then another 3% the very next day. So this thing can move on earnings. So let's just get that opened up there. All right, excuse me for one moment. I don't know why my mouth is so dry today. Okay, sorry about that. All right, let's talk about Darden Restaurants. All right. Okay. All right. Darden Restaurants, ticker symbol DRI. It stumbled a bit with its Q2 earnings report this morning. The company reported decent results, but the upside it achieved in Q2 was smaller than that of each of the past 3 quarters. Also, its fiscal year 22 EPS guidance was a bit underwhelming, even though DRI did increase its revenue and comparable sales guidance. If all of that was not enough, Darden also unveiled a change at the top by naming a new CEO. That's right, this sudden change of leadership at the top, but it may not be as big as one might think. There is a lot to unpack here for this casual restaurant chain. Its primary banners are Olive Garden and Longhorn Steakhouse, but it also has some smaller chains as well. In fairness, DRI reported upside for both EPS and revenue in this quarter. That upside just did not That upside just did not live up to the blowout results the company posted in each of the past 3 quarters. However, I must say, I nevertheless take that result as a win given peer Brinkers, ticker symbol EAT, EAT, its recent huge miss. So this wasn't really that bad for DIR. Investors seem troubled by the fiscal year 22 guidance, which is below estimates. The company actually increased the lower end of its EPS guidance to $7.35 to $7.60. That's up from $7.25 to $7.60. So they raised their lower end of their EPS guidance by 10 cents. However, analyst estimates that its target should be above $7.60. DRI tends to give conservative guidance, and I think that's why analyst numbers exceeded the company's guidance. Investors likely are concerned that DRI did not raise guidance, but in light of inflation and uncertainty surrounding the Omicron variant, it's probably prudent that the company did not. Same restaurant sales are a closely watched metric, and not surprisingly, DRI saw huge comps in all banners after lapping partial closures last year. Considering comps were up 34.4%, granted, that's down from 47.5% comps in August quarter and 90.4% comps in May's quarter. But that was to be expected as the pandemic closures eased in summer and fall of 2020 and curbside service picked up. Comps were quite strong across all banners, including up 29.3% growth for Olive Garden and 31.2% growth for Longhorn Steakhouse. On the positive side, DRI did raise full-year comp guidance for the second time in as many quarters, now at 29 to 31%, up from prior guidance of 27 to 30%. That is pretty impressive considering all that remains unknown with the Omicron variant. The CEO change may be causing some uneasiness as well, given the success that DRI has realized over the past 7 years with Eugene Lee Jr. as CEO. He's going to retire as CEO on May 29th. However, DRI named a long-time insider, Ricardo Cardenas, as his successor. So I do not expect the transition to yield a lot of change. He began his career with Darden as an hourly team member in 1984. and has held various executive roles at the company, including CFO. He's currently COO. Bottom line, DRI had a decent earnings report, but it was not on par with the blowouts I have been accustomed to in recent quarters. Also, investors seem a bit let down by the EPS guidance. However, DRI is facing what it describes as the toughest inflationary environment it has seen in years for both commodities and labor. For that reason, I am a little concerned about the EPS guidance, especially considering its huge miss. Also, DRI raised its revenue and comp guidance despite the Omicron variant emerging, so it's not all bad. Finally, because the new CEO is a longtime insider, I view the transition as a relative non-event. Perhaps investors had been hoping for an outsider that might come in to provide a fresh look. But why fix something that's not broken? It's a great adage, isn't it? Let me know what you think about this CEO change. Do you think Darden Restaurants should have went with an outsider to come in, ruffle up the feathers, and change the company? Or do you think keeping the ship on a nice and steady path that it's been on for years was the right call by hiring an insider, someone who started at the company as an hourly restaurant employee? Let me know what you think about that in the comments. Okay, if you found these videos to be helpful, informative, actionable, then there's 3 things I would love for you to do. First, click the like button. That lets other people know that this video is worth watching. The second thing to do is to grab the URL and share this video everywhere. Post it on all of your other social media platforms. That helps let YouTube know that this video is worth it. Then, what really helps, and the third thing to do, well, actually, this month, and only this month, there's actually a fourth thing. But the third thing is to click the first link in the description, and that'll take you to our Patreon page. That helps all of us reach financial freedom. And then the fourth thing to do is don't forget about the promotion from Webull. Get your 5 free stocks from Webull today. Just click the second link in the description or go to tickertimenews.com/Webull. Sign up, deposit any amount, $5, $10, $100, it doesn't matter, and get your 5 free stocks, valued up to $8,300. Those are the 4 big things that you can do to help out this channel and help us reach more people for our ultimate goal of financial freedom. All right. Be on the lookout this weekend for Patreon members. We are going to have our very first Patreon member only video coming out tomorrow, Saturday. And we'll have our Catalyst Watch video up on Sunday. I know I missed it last week. That was the one and only time. Just wasn't feeling myself and don't want to give you guys a halfway done something, right? Okay, so watch for that on Sunday evening, our Catalyst Watch video. It's the most important video all week long. Okay, well, that wraps it up, ladies and gentlemen. It is a Friday. I know there's not many watching, so hopefully you are watching the replay of this on Saturday. And I hope you're having a good weekend if you are. And remember, if you have a question, leave the ticker symbol and your question in the comments, and we will go over it live during the show. Okay, so watch for videos all weekend long. Our Catalyst Watch video Sunday evening, and then I'll be back here around 5 p.m. Eastern on Monday for another market close live stream for the after hours show. So everyone, thank you for joining me today. Thank you for watching, and I will see you in the next video.